It's great to have your company for the yearly wrap this Friday, the 18th of December. I'm Jessica Amir, a market analyst with Bell Direct. Well, if you ask Google how to describe 2020, it gives you three words: unprecedented, omnishambles, and hellacious. We saw the quickest fall into a bear market in history, stumbling 37% from the Feb high to the March low, and then the quickest recovery, charging 49% to where we are now, a new 10-month high. The market is telling us 2021 will be a good year for the economy and for earnings. And to that end, positive company earnings upgrades have started to come through. As of Friday, the 18th of December, the market is now up 1% this year. But let's look at the sector performance for 2020. The most bullish, the tech sector, up about 60%, blowing others out of the water given the rise of online shopping, buy now, pay later, and the shift to working from home. Materials are up 14% as the iron ore price charged 63%. Copper price is up 27%, and the nickel price is at its highest level since October 2019. The most oversold sector, energy, down 28% after the oil price went from $60 US to negative 37.63 and then recovered to where it is today at about $48 US. Utilities lost 17% as there's less people in CBDs. Industrials, which includes airlines, property and financials like banks and insurance stocks, are doing poorly, but these undervalued areas have seen the most buying of late. Now, looking at the standout stocks, there are three key trends to draw out. Firstly, stocks benefiting from the stay-home economy, like Afterpay, are up 306%. Net Wealth up 119. Xero, NextDC and ARB are all surging. The second trend, there's stocks benefiting from the return to normalcy, from economic growth and from China's palette of Aussie commodities. Like Fortescue Metals is up 109, Mineral Resources is up 98, Oz Minerals up 81. And the third trend, the worst performers of 2020 have been the best performers of late, rallying on the back of vaccine hopes and as people are starting to get the jab in the UK and the US. Flight Centre is down 59% this year. In November, its shares flew 52%. Now, its shares are in a bullish zone and there's signs of a flying recovery. Local capacity in New Zealand, for example, was now at 90% of pre-COVID-19 levels. Now, FLT is raising $400 million to repay debt and to have enough cash until mid-2022. Another example, Unibail Rodamco Westfield, their shares are down 55% this year. In November, their shares rose 73%. Now, once a vaccine is rolled out in Europe, you'd think people will start to return to the shops. URW is also raising 2 billion euros to reduce its debt, so that's a consideration. And energy stocks underperformed the market this year. Oil Search, for example, down 48% this year. OSH was one of the best performers last month, though, up 41%. What's the takeaway here, though? Undervalued stocks with earnings growth potential have seen a lot of buying. Now, this is expected to continue, given the market's expecting forward earnings growth, which drives share price growth. But when it comes to oil stocks, consider the WTI price is tipped to remain weak in 2021. So the question is, how much can oil companies' earnings grow? Well, I'd be perhaps looking at companies like Beach Energy, which are not exposed to the LNG and coal seam gas market. Now, half of BPT's production is sold to the local gas market, so its revenue is less volatile than oil-linked production. So think about that. Now, thinking more broadly, where can the market go from here? Well, firstly, I'd consider the fundamentals are there for the market to move higher as earnings are starting to rise. Business and consumer confidence levels rebounded and the economic recovery is happening faster than expected. Morgan Stanley is forecasting the ASX 200 to rally 8 to 10% next year. Now, Bell Potter expects earnings per share growth of 15% next financial year. Now, secondly, consider that we're in a domestic-led recovery fueled by government support. So look for those undervalued sectors likely to see strong earnings growth. Let's take the insurance industry, for example. It's tipped to see earnings per share growth of about 150%. And if you looked at IAG, QBE and Sun's share charts, they're all at a key inflection point. But keep in mind, La Nina, occurring every few years, just started to rear its head and will stay around likely until February, which could see insurance claims spike. Now, other Undervalued sectors with strong forward earnings per share growth are banks and diversified financial firms with EPS growth of 20% expected. So you could look at companies like Macquarie, Rays, Auswide Bank, MyState, and fund managers like Janus Henderson, etc. And thirdly, the IT sector, well, it's expected to see further earnings growth. EPS of 33% is expected. Also consider Afterpay and Xero could see forced buying from index managers from December 21, as those stocks will be added to the ASX 50. And Kogan.com is no exception as well. It'll be added to the ASX 200. And lastly, consider if you're looking for stocks with strong balance sheets that could see earnings and share price growth over the next coming years. Well, Bell Potter has put together a list of 14 stocks for you to watch, including Aristocrat, ANZ, Premier Investments, Flight Centre Travel, Qantas, Mirvac, Lendlease, BHP, Worley, Origin Energy, and Sonic Healthcare. Well, from all of us here at Bell Direct, we wish you a very safe and happy festive season. For daily stock ideas and what to watch, we'll see you for the Morning Bell.